In the stock market, what is risk management? Risk management is the process of evaluating, identifying, and ranking uncertainties or risks, as well as keeping an eye on, controlling, and lessening the effects of risk by using or following different strategies. In the rest of the video, the different ways to deal with the risk that is specific to a trade or stock are listed. Top 10 Risk Management Strategies. 1. Mitigating risk. Mitigation makes it less likely that a risk will happen or lessens its impact to a level that is manageable. The basic idea behind this risk management strategy is what makes it work. This principle says that taking steps to reduce the risk, its impact, or its likelihood is usually more effective than fixing the damage after the risk has happened. 2. Avoiding risk. By getting rid of the root cause, avoidance gets rid of the risk that comes with it. It could cause someone to change the way they work. Traders may also focus on one thing or change their goal, which is bad. Several trade risks can be avoided if information is gathered early and shared between shareholders or if different indicators are used. 3. Using stop-loss orders. A stop-loss order is an important tool that lets your financial service provider sell your stocks automatically if they fall below a certain point. Stop losses protect you from sudden, unpredictable changes in the market and keep you from losing too much money. If you buy a stock for Rs 200 with a stop loss of 190 rupees, your financial service provider will sell the stock when it falls to 190 rupees. It keeps you from losing more money if the stock falls below 190 rupees. 4. Diversifying a trader's holdings. Businesses are sensitive to a number of unknowns that make the price of stocks go down. Try investing in multiple baskets or stocks to protect your trading account from big losses. It makes sure that even if one of your stocks doesn't do as well as you thought it would, the other stocks will make up for it. When you're trying to spread out your investments, try to buy stocks that have nothing in common. If you keep buying the same stocks, you will always face the same losses and risks. Also, keep in mind that diversifying your portfolio doesn't mean putting the same amount of money in every sector. It means putting money into more than one industry or stock. You can spend more on companies you feel better about. Don't put so much into the trade that you can't afford to lose if things don't go the way you thought they would. 5. Expanding the trading portfolio to include non-cycle. Non-cycle businesses sell things that people need, like fast-moving consumer goods, FMCG, and pharmaceutical stocks. Because of this, the industry keeps going. No matter what the economy, county, or state is like, people can't stop spending money on food and healthcare. At best, they might be able to reduce how much they spend on a few essential services and goods. Non-cyclical stocks are a relatively stable way to make money, and their steady stock prices reflect this. These stocks are called defensive stocks by many experts and analysts. 6. Buy stocks that pay dividends. It has companies that have been giving consistent dividends for a long time. This group is usually made up of well-known stock companies. By adding these companies to your trading portfolio, you can avoid the risk of sudden price changes on the stock market. Most of the time, these companies don't want to lower their dividends because the market sees that as a sign of bad financial health. These companies that pay dividends also make sure you get a steady return, even if their prices go down. So, they lower your risk by making your trading portfolio more stable and predictable. 7. Hedging. Hedging is a way to manage risks in the stock market by using derivative tools like options contracts or futures contracts. A future agreement is a contract between two parties to sell or buy an asset at a certain date in the future. With this contract, you can reduce the risk that comes from price changes. For example, if the price of a share goes down, you can sell it for more, which you fixed. In the same way, if the price goes up, you can buy it for less. Different kinds of derivative agreements can be used for different things. 8. Putting money into big-name stocks. When we talk about risk in the stock market as a whole, it doesn't mean that every stock is risky. On the stock market, stocks of medium-sized and smaller companies can be more volatile and risky. This is because these kinds of businesses are more likely to face a number of business risks. Firms that have been around for a while can also be more stable. It is also used to set the prices of their stocks. By choosing these stocks, you can lower your risk. 9. Making a plan. When trading on the stock market, it helps a lot to make a strong plan ahead of time that includes entry points, exit points, and ways to handle risks. It's a plan that keeps you from making decisions based on how you feel and helps you figure out different prices. 10. Acceptance. Acceptance is the only good strategy, especially when there is no other way to get rid of the risk. There are two ways to accept something: actively and passively. In conclusion, managing risks is an important part of the financial market. It is a very important part of trading on the stock market. So, having a good plan for management can help you get the most out of the market.